Hey everyone, it's Elran here. Today I want to talk about something pretty scary. Finding out that the company you invested in has manipulated its financial reports. Reports manipulation could make the financials of the company seem better in the reports than they actually are. And you wouldn't want to invest in this company in the first place because you don't like its financials. It might even get worse when other investors find out about it. They could cash out immediately and make the stock price fall significantly. Okay, so we will see how companies do it, how you can spot it, and how you can avoid such things. Let's start by hearing what Warren Buffett says about it in this old interview from Berkshire Hathaway annual meeting.
Well, the practices are some of the things we've said. They relate to accounting charges that are designed to throw into a given period a whole lot of things that should have been covered in subsequent periods in the earnings account, or to smooth out or to inflate earnings in future accounts. There's a lot of that being done. There's a lot of it's been done.
After we just heard this interview with Warren Buffett, to understand what he means, we must introduce two concepts. And the first concept is called big bath accounting, or called shower accounting. Big bath accounting basically means that a company makes an unsuccessful financial period to an even worse financial period for the company by shifting profits from the present to the future, for example. And it might be a little baffling, because why would anyone want to do that? At first glance, it seems like it could only make things worse for them. The short answer would be to make the next year look better at the expense of this year, because this year already is as bad as it can get for the management. For the longer answer, let's first understand the public company's management interests. In many companies, the management receive a compensation for good financial performance every year to give them an incentive to perform better. Let's say that Bruce here, hi Bruce, runs the company. If Bruce performs great in a given year, he will be compensated accordingly. But if Bruce is not able to achieve the minimum earnings for the company that he runs, he will not get compensated or get very low compensation for that year. So what can Bruce do now? He already knows that his company performed poorly in 2022 and he will not get compensated for this year. But he can still get compensated for 2023 if the company performs well in that year. If the company's management sees that it can't reach the minimum earnings for a given year to get that compensation, they have an incentive to move earnings from the present to the future, because their compensation doesn't change if they miss the target by a little or by a lot. So, if the target for the compensation was 2 money bags, Bruce can try to find a way to make it look like he was able to achieve those 2 bags in 2023 at the expense of 2022. Now, Bruce, as the company's CEO, have better chances to reach high earnings in 2023 and therefore will be compensated accordingly. So we saw why companies would want to manipulate their financial reports, but how do they do it? The company's management can shift profits and expenses from one period to another by prepaying expenses, for example. Let's say that the cookie company, Cookie Chef, needs 100 pounds of flour each year, and each pound costs $1. We'll assume that the Cookie Chef company makes $1,000 in revenues each year, and their only expense is flour expenses. So their profit will be the revenues minus flour expenses, and that makes their annual profit $900. If the management needs $1,000 in profits to get a compensation, you can see they are in trouble now, because they will not get compensated for 2022 and 2023. Now this is where it gets interesting. Let's introduce a new concept called prepaid expenses. Companies can pay the suppliers in advance for a supply that they will receive in the future. The company could prepay the suppliers for the flour supplies they need for 2023 in 2022, which means they will pay the suppliers in 2022 and get the flour they paid for only in 2023. Let's say that the company's management decided to prepay the suppliers for additional 100 pounds of flour this year that they will receive next year. The cookie chef company must recognize the 200 pounds of flour that they bought as an expense in 2022 because they already paid for it. That will make the flour expenses for 2022 to double, and in 2023 they will have no flour expenses. This change in expenses will also affect the profits because it changed the expenses they subtract from the revenues to calculate the profits. In 2022, they will have a profit of $800 instead of $900, and in 2023 they will have a profit of $1,000. So the management was able to get to $1,000 in profits in 2023, and they will be compensated for that year, a compensation they wouldn't receive if they didn't change the reports by prepaying suppliers. Okay, so I promised you we will cover two concepts of financial manipulation, and after we explain big bath accounting, the second concept is very easy to understand. The second concept is called cookie jar accounting, and it is very similar to big bath accounting. Cookie jar accounting or cookie jar reserves is an accounting method in which a company takes reserves from a financially successful year and transfers some of the profits to the next year by similar methods used in big bath accounting. So you would probably ask yourself now if it's illegal. Well, surprisingly, not necessarily, because it can be done within the boundaries of accounting rules of financial reports. So if it's legal, what's all the fuss about? Most investors see it as an unethical method, since the financials of the company may seem better than they actually are. Even though it's not necessarily illegal, you'd probably want to avoid it. To spot it, compare the last financial reports of the company to the reports of the previous year. Try to spot big changes with no apparent reasons. If you see a big difference in prepaid expenses or a big reduction in expenses this year, for example, it could mean the company is using big bath accounting method. In conclusion, you should always search financial reports for this kind of manipulation, and if you spot such possible manipulation, think if the company's management had good reasons for taking such actions, and if you can't find any good reasons, think how it influences the company's earnings and your decision to buy the stock.